Welcome to StockStream's Education Series. This presentation is brought to you by StockStream Financial Services in collaboration with MyStockStream.com. Today we will look at the basics of carry trade. We recommend that you treat the contents of this presentation strictly as educational and informational in nature. We propose that you learn concepts of analysis using StockStream Education's training material. Then follow StockStream experts at MyStockStream.com to see the techniques you have learned being applied to live markets. Once you are comfortable with a particular technique, we recommend that you conduct your own analysis, get it reviewed by a StockStream expert, and then put it to trade in live markets. Currency trading is done in pairs. You essentially buy one currency and sell another at the same time. For example, if you go long Euro USD, you're buying euros and selling US dollars. Holding a particular currency entitles you to a certain interest income as decided by the central bank for that country. Think of it as similar to the interest you're making in your own bank account. This interest income can be significant in Forex markets due to the leveraged nature of the trades. Going back to our Euro USD long example, if the ECB is giving a 1.25% interest for holding euros, and the Fed is giving a 0.25% interest for holding the USD, you make a net interest income of 1%. This interest income is called the rollover amount and is credited at the end of every trading session in your trading account. A position that earns a positive rollover is called a carry trade. Carry trades have a tendency of maintaining their trends for extended periods of time, sometimes months at a time. There are fundamental reasons related to interest rates for these prolonged trends. Fundamentally, we know that currencies with higher interest rates and interest rate expectations tend to be in an uptrend compared to currencies with lower interest rates and expectations. Therefore, if we are able to get into a currency pair with high rollover rates at technically significant levels, we will be able to make profits on both interest and price changes. The trading strategy involves identifying currency pairs with the highest rollover rates. We then narrow down this list by looking at interest rate expectations for the identified currencies. For currency pairs with interest rate expectations aligned with rollover rates, we use technical analysis to identify an entry point, stop, and limit on the trade. This position can be held until the technical targets are met or changes in interest rate expectations tilt the fundamentals against the trade. For example, based on the current interest rates, the Australian dollar and New Zealand dollar are among the highest yielding currencies, while the Japanese yen, Swiss franc, and the US dollar are among the lowest yielders. The expectation that the central bank will increase interest rates over the coming months is increasing for the AUD and USD, and is stable for the Swiss franc, New Zealand dollar, and Japanese yen. Currency pairs involving the AUD against the JPY and CHF are ideal candidates for carry trade longs. We will use technical analysis strategies developed in the previous sessions to look for buying opportunities in Australian dollar, Japanese yen, and Australian dollar, Swiss franc pairs. If you have any questions, visit MyStockStream.com and contact us at StockStream Education. You can also contact any of our other experts covering Forex, commodity, or Indian equity markets. We will be more than happy to answer any of your investment-related queries. Thanks for listening to this presentation and have a great day.